All right. Good afternoon, everyone. Thank you for joining us today for our student loan webinar, Understanding and Managing Parent Plus Loans and Other Updates. My name is Celina Damian. I am the Student Loan Servicing Ombudsperson at the California Department of Financial Protection and Innovation. It is my pleasure to be here today with Betsy Mayotte, who is the president and founder of TISLA, the Institute of Student Loan Advisors. She's been working in the industry for long time, over 20 years, and has helped thousands of borrowers with their student loans. Just a few things. We have 2 more webinars scheduled upcoming in the next few months, and you can subscribe to our newsletter to get information on those webinars. Some housekeeping items throughout the webinar. Your microphone and chat will be disabled. You can enter questions in the Q&A function, and we will go ahead and answer them as we're going. Please don't ask any detailed personal questions. Since this is a public forum, we will be providing our contact information so you can contact afterwards if needed. This event is being recorded and it will be available on our DFPI YouTube channel for you to view within the next few days. And also, this information is current as of today. So things are rapidly changing, but this is accurate. So let's get started. Next. Okay, so Parent Plus loans were originally intended for high income and high asset parents to subsidize, excuse me, their children's education. However, these loans have morphed from a niche program into a program that more low income and low wealth families are turning to. We are now seeing borrowers who are still paying on their loans, having to take on more debt for their children's education. Data shows that parents are taking on more debt and that they're taking longer to pay it off. And then more recently, Parent Plus borrowers have been excluded from many of the initiatives. So Parent Plus loans are still a great tool for college access if borrowers understand the risks. And it's also important that those that are paying understand their options and manage the debt. So thank you for being here. And today we're going to discuss we're going to have an overview, give you an overview of Parent Plus loans, and then we're going to talk about repayment discharge options and some of the current updates, and then rights and resources. So I know that threw you off, Betsy, but if you could go back to the one right before the about DFPI. So we are California's Consumer Protection Agency. We regulate companies of financial products to ensure compliance, and that does include federal student loan servicers. We accept and we evaluate consumer complaints, and we take enforcement and legal actions as necessary. We conduct this type of outreach to enhance consumer awareness and to protect borrowers from fraud and abuse. And TISLA is a nonprofit organization, nonprofit agency that offers free, expert, unbiased advice. And then that is the TISLA email. Next, please. So Parent Plus loan, so a direct plus loan, that's the official name, is commonly referred to as a Parent Plus loan when made to a parent borrower. These type of loans are made by the Department of Education to parents of undergraduate students who have exhausted their own financial aid. It's to supplement their aid. Parent Plus loans were created in 1980 during the Higher Education Act reauthorization in response to demands for increased federal funding. And at that time, they had annual and aggregate borrowing limits. Then in 1992, the borrowing caps were eliminated. And then in 2014, lower eligibility requirements were implemented. Currently, there are 3.6 million borrowers that owe $100 billion in Parent Plus loans. And in the United States, borrowers owe a total of $1.78 trillion of student loan debt. Next, please. The current rates and terms for Parent Plus loans, this is effective July 1st, 2024 through July 1st, 2025. Just to note, the interest rates on parent loans are a bit higher. These are fixed interest loans. The interest does not change, and then they are unsubsidized loans. That means that interest starts accruing from the time that the loan is disbursed. That's different than your direct subsidized loans that are made available to undergrad students. So the terms and rates for Parent Plus loans are a little bit more unfavorable and the rates are a little bit higher. So as you can see, the interest rate currently is 9.08. Whereas the direct subsidized loans for students is 6.53. So it's about 2.5, 2.5 points higher than regular loans. And then there is an origination fee for all Direct Plus loans. Currently, it is at 4.228. And this fee is a percentage is taken out of the disbursement when prior to being dispersed to the student. I added here just some of the names of the federal student loan servicers, and since we're not doing a full overview, but these are the companies that are managing your loans. So they don't determine the interest, the fees, they just manage the loans, and they're the ones that you're probably already having contact with, the ones that are contracted by Ed to take your payments, answer your phone calls, process applications. These are those companies. Next, please. Loan limits. Now, for Parent Plus loans, this is probably the reason why these loans are a little bit more riskier. The loan limits, basically, there are none. You can borrow up to the cost of education minus other financial aid received. There is no debt to income ratio utilized in eligibility determination. This means that there is no consideration of your income or the parent's income when they are applying for these loans. So you could have an income, as long as you don't have adverse credit or recent bankruptcy, delinquency, or charge off, you can pretty much take out as much as is needed for your child's education, and they will not look at your current income to determine if you can make the payment. That's different than even when you go and purchase a car, mortgage. With this type of loan, they will not look at if you're making $30,000 a year and you're taking out $100,000 Parent Plus loan, or if this is your third child and you're taking out even more debt. So this is, I think, why, as I said, makes these loans more riskier, and parents are able to borrow a lot more. Next, please. With Parent Plus loans, there is no grace period as with the other type of loans. Repayment begins 60 days after the loan is fully dispersed. It can be deferred if the borrower, the dependent student, is in school at least half time, and then it can be deferred an additional 6 months after the borrower or student withdraws. So basically, you can get a deferment. You can have a grace period, but during this grace period, the outstanding interest, which started accruing from the minute it was dispersed, it will capitalize at the end of the deferment, which really means that this loan is going to be more costlier in the long run if you are not making payments. So you can make the payments during the deferment, but no bill will be issued. So you will have to be proactive and find out who your servicer is, call the servicer to make those payments. The repayment term for these loans is 10 years unless the loan is consolidated or if you request a different payment option. Next, please. I think here we are looking. So just a few things. So Parent Plus loans are the sole and legal responsibility of the parent borrower or the endorser if one is utilized because you had an adverse credit and weren't able to borrow. Most repayment forgiveness and discharge options are based on the borrower's information, not the student's. So an example in which we'll talk about briefly, PSLF, it is based on public service loan forgiveness. It is based on the parent's employment. It is not based on the student or your child who you took out the loan for. So we get that question a lot. So if you are a parent that took out a parent loan for your child and you aren't in a nonprofit and government and a qualifying employer, then you can qualify for you can apply and qualify for PSLF. Parent cannot transfer the loan back to the student once the student graduates, so it is the sole responsibility. You also can't transfer it to the other parent. And then if you refinance into a private loan, this is for any loans, you cannot revert back to a federal loan. So just be very careful if you are offered a better rate with the private lender. Just remember that you will lose any benefits that you do have with the federal loan. So for example, many borrowers that refinanced pre-COVID and they weren't able to take advantage of the payment pause and they had to continue making payments. So private lenders also have to give you information and specifically tell you that you are losing federal benefits when you are refinancing. So that should be a disclaimer or part of the refinancing. And we've heard of some private lenders not doing that, not informing borrowers properly. So keep an eye out for that. Next, please. So once you get into repayment on one of these loans, you are automatically placed on the 10-year standard plan. It is the same payment for 120 years, and then it is generally the cheapest plan. We do have our 3 other standard options, completely separate than the income-based plans, which a borrower has to apply. So in this case, a parent borrower has to apply for one of these other payment plans. And on our next slide, I believe there's a comparison. So just a comparison, this is a $60,000 loan, 3% interest, and a family of 5. If you look at which plan ends up being the least expensive, it is going to be your standard repayment, the 10-year term. But if you extend the term for 25 years, then you are looking at your total to be paid. As you can see, it's quite a bit more, but again, you may not be able to, every case is different, just to show you how they break it down with these terms. Next, please, and how long you'll have to be paying, 15 years additional. So another consolidation. So consolidation is the process of taking all your federal loans and consolidating them into one direct consolidation loan. They are still federal loans. This is different than when you refinance with a private lender. You can consolidate your Parent Plus loan into this direct consolidation loan. If you consolidate more than one, you will receive a weighted average of your interest rate. So at this time, that fixed interest rate may change. It extends the term for up to 30 years. And then it allows Parent Plus loans to be eligible for Income Contingent Repayment Plan, the ICR plan, which is one of the 4 income-based plans. So as I said, I showed you the bucket of the standard plans, and then income-based plans are plans that are based on your income and family size. They have nothing to do with your account balance. This is the only way that a parent borrower can become eligible for ICR. When you consolidate, you can combine these Parent Plus loans with your own loans. However, we do have to warn you that once you do that, your own student loans will lose eligibility for the other income-based plans, and you will be limited to only the ICR plan. So when you combine your own loans with a Parent Plus loans, you are left with only ICR, which again, you'll have to look at the monthly payments, but it may end up being a little bit higher payment. And Betsy will talk about that, but that's one thing to consider. If you are pursuing PSLF or in public service, then it is strongly advised that you consolidate in order to get you on track for public service loan forgiveness. Next, please. And then I will hand it over to Betsy to talk about just more in depth about the ICR plan.
Thanks, Celina. So, and thank you for the explanation you've given about some of the payment plans available to Parent Plus borrowers. And I'm going to talk about some more. And I'm also going to talk about a way to possibly access some of the other income-based repayment options that we haven't talked about yet. But before I do that, I just want to, remind people when you're looking at these payment plans, and, if you look at the example that Celina went over a few minutes ago, it's not just about getting the lowest payment possible. It's about paying the least amount over time. And, for some people, that might mean getting the lowest payment possible because you're pursuing loan forgiveness under, say, public service loan forgiveness. But for others, it's also really important to look at that total amount to be paid number. For all federal student loans, there's never a prepayment penalty. You can always pay the loans off early, and doing so will save you sometimes a really significant amount in interest over time. The other thing to note is that it's generally not a set it and forget it. Or it shouldn't be. I strongly urge everybody within the sound of my voice to reevaluate your student loan strategy on an annual basis, because your financial situation and or your financial goals might change. So maybe right now you need the lowest payment possible, but maybe 2 years from now, you might be able to afford to pay a little extra and therefore save yourself a lot of money over time. And, the sooner you pay the loan off, the less you will pay in interest. So those are some things to keep in mind. So let's talk about the different repayment plans. So Celina already talked about the ones that are not based on your income. And if you have a Parent Plus loan, you're not required to consolidate to access those. Your payment amount under those non-income driven plans is based exclusively off of how much you owe, your interest rate, and what the term of your loan is. Now I'm going to talk more about the payment plans that are based on income. Now, Parent Plus loans in and of themselves, as Celina mentioned, are not eligible for any of the income-driven plans. However, if you consolidate them once, they become eligible for ICR, which I'm going to talk about in a second. And then if you hang on, I'm going to talk about something called the double consolidation loophole that can allow Parent Plus borrowers to actually access some of the other income-driven plans. And for most borrowers, unless your income is very high compared to what you owe in federal student loans, ICR is actually going to be the most expensive income-driven plan for you. So again, unless your income is very high compared to what you owe with Parent Plus, you're going to want to stay tuned to hear about that double consolidation loophole and those other income-driven plans. But if you don't want to go through the shenanigans, that is the double consolidation loophole. You just have to consolidate once, and these Parent Plus loans are eligible for ICR. Now, the way ICR is calculated is they take the lesser of 20% of your discretionary income, and I'm going to tell you what discretionary income means in a second, or what your payment would be if you under a 12-year repayment term, and then they take off a percentage of it based on what's called an income percentage factor. That income percentage factor is something that changes every year, and the income percentage factor that is used depends on your income. And the amount they're removing based on the income percentage factor goes down as your income goes up. So the easiest way to let me just tell you outright, this is probably the most complex piece of any of the income-driven repayment plans. Most of you are probably going, just tell me what my payment would be, lady. Right now, the studentaid.gov calculator is not displaying ICR, but there's a bunch of other ICR calculators out there. So if you Google income contingent repayment calculator, you can get a sense of what your payment would be under ICR. Some of the other income-driven plans require you to have what's called a partial financial hardship to get into the plan in the first place. And I'll explain what that means in a minute as well. But you're not required to have a PFH to get into ICR. So basically everybody's eligible for ICR, no matter how old your loan is, no matter what your income is. For Parent Plus loans, you just need to have a consolidated Parent Plus loan to get into it. Now, ICR, for years and years, it's been around since 1994. And everybody was, the way the regulations were written, it said that if you were on ICR for 25 years and you still had a balance after that 25 years, they'd forgive it. However, due to some litigation around another payment plan called SAVE, the court is questioning whether Congress ever intended for there to be a forgiveness component for ICR. So right now, right this second, there is no forgiveness for ICR. However, we don't know what that means. We don't know the court case isn't over yet, so the forgiveness could be coming back. The other thing that is sort of a wild card here is, and I'm going to talk more about this at the end, is the budget reconciliation bill. And the House markup that came out this week would allow, borrowers that are on ICR to get into a new proposed income-driven repayment plan and be able to get forgiveness. So I don't think it's going to be sort of a brick wall for borrowers in the situation that have been on ICR for a long time and all of a sudden are worried that forgiveness might get ripped out from under them. I do think there's going to be a resolution for those borrowers. We just don't know what that is yet. And for those of you pursuing public service loan forgiveness, because you have Parent Plus loans in your name and you are working for an eligible PSLF employer, ICR still counts. There's no threat to ICR counting towards PSLF. It still counts. And as far as I can see, it will always count for PSLF. So no worries there. All right. So I promised that I would define what discretionary income means as far as the income-driven plans go. So no, when you and I think of discretionary income, what we usually think of is our fund money, the money we have left over after we've paid our bills, put money into retirement, hopefully put some money to savings. So the money we have left there. But discretionary income is defined very specifically under the law and regulations as far as the income-driven plans go. It's defined as, for ICR, it's defined as whatever your adjusted gross income is, and then they subtract whatever the poverty level is based on your family size and state. So for example, if you had an adjusted gross income of 62 grand and you were a family size of 4 living in Maryland or living in California, it's the same. The poverty level for that is 26,200. So they'd subtract that from the 62,000, leaving you with a discretionary income of 35,800. You divide that by 12 for 12 months in the year, you get 29,83. 20% of that, which again is the ICR calculation, would give you a payment of almost $600 a month. If your income was very high, chances are the lower calculation would apply, which is that 12-year term minus the income protection allowance. Now, if you're married and you file your taxes as married, your AGI is going to be both you and your spouse's income. But if both of you have loans, they're not only going to take both incomes into account, they're also going to take both loan balances into account, especially if both spouses are on some sort of income-driven repayment plan. Now, if you file separately, they're only going to use your income. Now, with that said, you're also going to lose those sweet, sweet marriage tax benefits. So you're going to want to do the math there and see which is more beneficial to the overall household budget. Now, the exception to that, of course, is community property states. If you live in a community property state and you file your taxes as married filing separately, your AGI is going to be 50% of the total income between the two of you. All right, I want to talk about public service loan forgiveness and Parent Plus loans. So, explaining all the gory details of PSLF is a 90-minute presentation all by itself. So unfortunately, we're only going to be able to talk about this at a really high level. Parent Plus loans are absolutely eligible for PSLF. And as I mentioned, as Celina mentioned, if the parent borrower is they themselves working for an eligible employer. So even if your child's making the payments on the loans because they were for their education, that's fine. They can do that, but it has to be the actual parent borrower who is working for the eligible employer. It's a program that was created back in 2007 under Bush II, and it was made to encourage individuals to enter into and stay in public service careers. So what they had in mind were people that wanted to go into things like teaching or social work or being a public defender. And what those careers have in common is they all require a graduate degree to be able to practice in that field. And that's where your people tend to really rack up the debt. And those careers also tend not to pay as well as if you worked in the private sector. So the way the program works is that if you have to work at least 30 hours a week for either a government employer, and that's any government employer, federal, state, local, tribal, or any 501c3 nonprofit, or there are some other nonprofits that count, but there's some other sort of boxes that you have to check to make sure that they qualify. You have to be working for one of those employers while making payments under an eligible plan. And an eligible plan is either a 10-year standard plan or any of the income-driven repayment plans. So for Parent Plus borrowers, you really have to consolidate, or better yet, double consolidate, which again, I'm going to talk about later, and get on one of these income-driven plans to really benefit from PSLF. Now, as of May of last year, almost 1 million borrowers had received forgiveness under PSLF. And I expect that those numbers to continue because we're far enough along that more people have actually been in repayment and working for eligible employment for the 10 years. The program got a bad rap for only 1% of people get approved. I call that a factual myth. Back at the time when that sort of popped up, it's true, only about 1% of people got approved. But the fact of the matter is most people actually hadn't been in repayment long enough to have hit that 120 eligible payment mark. And now that we're further along in time, we're seeing a lot more people get approved for PSLF. The last thing I'm going to say about PSLF is the best way to determine if your employer is eligible is to use the PSLF help tool, which you can find at studentaid.gov. All right, so just to give you a sense of what your payment would be under the different plans, if we're looking at about 80,000 in loans under the extended, which is the 25-year fixed repayment plan, your payment would be about $364 a month, and it wouldn't change. You'd pay back a total of $109,000, and you'd have it paid off by 2045, and you wouldn't have anything forgiven. If you were on extended graduated, which is interest only to start with, your payment would start at $292. It would never go above about $513. You'd pay back almost $10,000 more over time, and you'd be done by 2045. If you were on ICR, again, assuming a AGI of about 62,000 and a family size of 4, your payment would start at around 566. Assuming you got a raise every couple of years, it could go up to around 583. You'd pay back a total of 68,000, and you'd get forgiveness, maybe depending on what happens with the save litigation and with budget reconciliation. But under the original scheme, when you would definitely get forgiveness after 25 years, that would happen for you in 2030. Sorry, that's not wrong. 2030 would only be 5 years from now. But you'd get the forgiveness in about 25 years, and that amount would be about $12,000. Now, let's talk about that super secret double consolidation method. So let's be clear. It's not so secret anymore. It used to be very, very few people knew about it. It is absolutely legal. There was a deadline for this that was put into regulations, and that deadline was July of this year. And if it was still July of this year, I might not be talking about it because you might not have enough time to do it by July 1st. However, the save litigation, the same one that might prevent ICR forgiveness after 25 years, also the most recent injunction made the whole regulatory package that created the save plan and created the July 1st deadline for double consolidation. It paused that. Now that deadline could be coming back. I highly doubt that the new deadline would be July 1st, which means that if you're just hearing about double consolidation now, go ahead and start it. I wouldn't dawdle, but I fully expect that you will have time to finish it because I don't think that I think a deadline will come back, but I don't think that it will be July 1st. In worst case scenario, even if it is July 1st, you haven't done yourself any harm because at least you'll still be eligible for ICR. Now, the way double consolidation works is let's say you had 4 Parent Plus loans, and we're going to call them loans A, B, C, and D. The first thing you need to do is consolidate loans A and B together, and that would create consolidation 1. And you would consolidate loans C and D together, and that would create consolidation 2. Now, you could do both of those at the same time. It's just really important that you pick different servicers and you use a paper application rather than the online application. By the way, I have all the step-by-step instructions written out for double consolidation on the TISLA website, which is freestudentloanadvice.org. Under the consolidation page, if you scroll down to the bottom. So don't worry about taking notes about this. So anyway, first step, you consolidate loans A and B into consolidation 1. Then you consolidate loans C and D into consolidation 2. And then once those are done and they exist, you consolidate loans, consolidations 1 and 2 together into consolidation 3. And the key here is to use a different servicer for every step. And while you can use the online consolidation application for one of the steps, I actually see less errors if people use paper for all 3. Again, the deadline of July 1st currently doesn't exist, and I don't think it's coming back, although a later deadline may come back, so I wouldn't dawdle. And again, if you want the step-by-step instructions for this, just see the consolidation page on the TISLA website. Now, if you're consolidating, only the parent borrower can consolidate the loans. So whether you're doing a single consolidation or double consolidation, you can only consolidate the loans that are in your name. You can combine, as Celina mentioned, not only Parent Plus loans, but if you have loans from your own schooling, like Grad Plus or Stafford, you can throw those all together in a double consolidation or a single consolidation if you want to. You cannot include any loans under your student's name. You can't include any loans that maybe you and your spouse split up the Parent Plus borrowing. So some are in spouse A's name and some are in spouse B's name. You can't consolidate those together. You can only consolidate the loans in your name. And the student can't consolidate the Parent Plus loans into their own name under the federal programs. Now, they can refinance them into a private loan in their own name, but that is an awful idea. Terrible, terrible idea. Celina already explained why. Now, I know a lot of families have sort of a handshake agreement where the student agrees to pay back the Parent Plus loan for the parent, and hopefully that's working out. But I still encourage you to keep the loans federal, and that's because federal loans, even Parent Plus loans, have a lot more protections and safety nets than private loans do. So, for example, if the borrower were to pass away or become totally and permanently disabled, the loans are discharged. That might not happen on a private loan. There are lower payment options like we've been describing, and there's almost never a lower payment option on a private loan. Private loans often require cosigners. So even if you're still, despite our dire warnings, considering asking your student to refinance your Parent Plus loans into a private loan, you'd probably have to cosign, which would still make you equally liable for the debt. And again, there's no lower payment options and very few discharge options. So if they can't pay, you would be on the hook, and you could be sued. The private lenders, if you're unable to pay, they tend to file lawsuits and get a judgment. So hopefully I've terrified you enough to get you to not consider refinancing a federal loan into a private loan. Another thing that Parent Plus loans have, and all federal loans have, that private loans tend not to have, is access to deferments and forbearances, which are ways to temporarily postpone payments altogether. Now, for Parent Plus loan, the interest is still going to accrue. And at the end of a deferment, if you don't pay that interest, it gets added to the principal in the form of in the form of interest capitalization. Deferments, just like everything else, is going to be based on the parent borrower's eligibility. And you can get it for things like being unemployed and actively seeking full-time work, or maybe you're on some sort of benefit like food stamps or another sort of social benefit. If you're in the Peace Corps, you can get an economic hardship deferment. If you're in a rehabilitation program, you can get a deferment. The only time you can't get a deferment is if you've already used all the deferment time, and most of them have a limited amount of time you can use them, or if the Parent Plus loan is in default, meaning that you didn't pay, the loan got delinquent by 270 days or more and is actually in a default status. If you yourself go back to school at least half time, you can defer the Parent Plus loans. And if the student for whom you took the Parent Plus loan out goes back to school at least half time, you can also defer the loans. And there's no limit to that particular deferment. The other way to postpone payments is forbearance. Forbearance, again, interest still accrues. This slide actually says will capitalize, but it actually doesn't capitalize at the end of a forbearance anymore. I have to go and fix that. They got rid of that last year. It used to be that interest capitalized at the end of a forbearance, but now it doesn't any longer. Now, there's a whole bunch of different kinds of forbearances. Some of them are what we call administrative forbearances that you have no control over. If something happens with your account and the servicer needs to put this administrative forbearance on it, they're going to put it on and you don't have a choice in the matter. And that can be for things like something that's very common right now. If you applied for an income driven plan and the servicer is unable to process it in the time that they're required to process it by, they'll put it in what's called a processing forbearance. If the place you live is designated a federal disaster area due to, say, a wildfire, then they'll put the loan in what's called a disaster forbearance, which is usually around 90 days long. If your loan transfers servicers, they might put you in an administrative forbearance to prevent you going delinquent while the loan's in limbo between the servicers. Now, there's also forbearances that we call general forbearances or voluntary forbearances that you can ask for. And you usually ask for them because you're unable to make payments due to financial hardship. And for whatever reason, none of the lower payment plans are workable for you on a very temporary basis. Forbearance is a temporary fix. It is not a loan repayment strategy by any means. And they're generally given for financial hardship. Now, they used to be given out like candy on Halloween. You just had to call the servicer and say, I can't pay because I lost my left sock and it's devastating me. And they would give you a forbearance. And that was the Department of Education as well as the old FEL servicers. Now it's a lot harder to get the forbearance. They usually make you talk about what your income is and maybe even expenses. And they're trying to get you to do a longer solution like a lower payment option rather than forbearance. But they're allowed to deny you if you ask for forbearance. But if you have a financial hardship and nothing else fits, and it's between that and going delinquent on your loan or defaulting on your loan, you should absolutely call and ask for it. In general, they won't give you more than 36 months of forbearance under the total life of your loan. And if you're in default, you're not eligible for forbearance at all. Okay, federal student loans also have programs that will make your loans go away altogether. Now, there's forgiveness programs, and I already talked about PSLF, and I talked about so far some of the income-driven plans and the forgiveness components that are baked into those. And there's also things like teacher loan forgiveness, although Parent Plus loans aren't eligible for teacher loan forgiveness, but other loans are. And those are all programs that I put under the umbrella that you get forgiveness because you did something good. But there's also programs where something bad happens to you and you can possibly get your loans forgiven. One of those is if you become totally and permanently disabled and are unable to work in a way that you can substantially support yourself due to that disability. There's also a forgery discharge. If your signature was forged or your personal information was used without your permission, and the loan wasn't used to benefit yourself or the student for whom the loan was taken, then it's possible to get the loan discharged. Now, listen, this is very difficult for federal student loans. And you actually need a court to state that you were the victim of identity theft and this loan was the result of identity theft. So you would have to file a police report. And if you know who it was who forged your signature, you have to file the police report against them and hope that the district attorney or whomever pursues charges. Or you would have to sue them yourself to get a court to state that person committed identity theft against you, and the result of that was this loan. Now, if the school closed and the student attended within either 120 or 180 days of the time that the school closed, and the student was unable to transfer their credits elsewhere, the Parent Plus loan can get discharged. If the school committed fraud regarding the program or the program's outcomes, meaning, for example, they advertise that the program has a 90% job placement rate, when in reality, it's only a 20% job placement rate. Or if the school advertises that all the professors are certified in their field by the state, and it turns out that none of the professors are. or if they advertise that if you complete this program, then you'll be eligible for state certification in that particular field. And it turns out that's not the case. Those are all potential reasons for what we call borrower defense to repayment discharge. What's not a criteria for borrower defense is, say, the student got injured on campus, or there was a civil rights violation, or the student got kicked out of school, or the student didn't complete their program and was unable to get a job in their field. Those are generally not reasons for borrower defense. Believe it or not, and there's a big myth out there that they can't be, student loans are dischargeable in bankruptcy, including Parent Plus. Now, it's not easy. You have to find a bankruptcy attorney that is well versed in particular in student loan bankruptcy, and you have to file what's called an adversary proceeding. And most courts follow what's called the Brunner test. And you can Google the Brunner test, BRUNNER. But to oversimplify it, you have to show that you made a good faith effort to pay, that making your payments would mean that you would not be able to have the money to feed and clothe yourself or house yourself, and that things are unlikely to improve in the fairly near future. Now, because of the income-driven plans, that it can be difficult to meet those prongs of the Brunner test. But it's important to know that bankruptcy is not impossible for federal student loans. And then if you should pass away, or the student for whom you took the Parent Plus loan out should pass away, the loans do get discharged then. Hopefully nobody has to take things up, use that particular discharge. One quick thing I want to go back to double consolidation for a second. If you go through the double consolidation loophole, the loan then becomes eligible for what is often lower cost income-driven plans. That includes income-based repayment. Now, there's an old IBR and a new IBR. Now, those plans also have a baked-in forgiveness component, either 20 or 25 years, depending on how old your loans are. The IBR forgiveness is not at risk by the SAVE litigation. It's written into federal law. So if pursuing an income-driven plan, forgiveness is on your list as a strategy and may work out for you, double consolidation is going to be something you're going to want to pursue. You also become eligible, depending on when you took your loans out, for the pay-as-you-earn program. That forgiveness is also at risk. But all those plans are also PSLF qualifying plans. And as I mentioned, they tend to be a lot lower than ICR. So if you're pursuing PSLF, that's another reason to consider double consolidation. And then finally, as I mentioned, double consolidation is not going to be, I'm convinced it's not going to be available forever. Even though the July 1st deadline is gone right now, I do think they'll create another deadline. And if you still have these loans when you retire and your income goes down, you're going to want to preserve access to those lower cost plans, such as IBR and pay as you earn. All right. Before I go into sort of what's going on politically, I just want to check in with Celina real quick and see if she's got any questions in the Q&A that might be good to address with the whole group. Celina or Katie?
We've answered a few. We do have one that's a little more like nuanced about Form 8958, allowing W-2 income, and then California community property state. So
okay, now so I am a student loan nerd. That is my only superpower. I am not a tax expert. So I'm afraid we're not going to be able to answer that particular question for you.
So you can consult with your tax preparer, and then they can assist you with that, possibly. Okay. But other than that, no, we just had some question. One, I think that is good for the group. They asked about capitalization, what exactly that was, and it's when unpaid interest is added to the total balance, to the principal, and then interest accrues on that new balance. So when we've mentioned capitalization a few times throughout the webinar, but I think that's it. You answered everything else. We've answered everything else. You can go ahead.
Thanks. So capital interest used to capitalize all the time. If you change payment plans, if you had a deferment, if you had a forbearance when you left school, if you wore a striped shirt on a Friday. But the Biden administration got rid of all instances that interest capitalized that they were allowed to that weren't actually set in federal law. And the two that are set in federal law are when you come out of a deferment, and if you're specifically on the plan called IBR and either fail to recertify your income on time or actively switch plans, then outstanding interest will capitalize. But other than that, interest doesn't cap anymore, which is wonderful. And budget reconciliation, I've seen some proposals that would even get rid of those other instances of interest capitalization. So fingers crossed on that. All right. So this has been listen, as Celina mentioned, I've been working in the student loan industry in a compliance and advocacy role since the earth cooled. And I can honestly say, without being overly dramatic, that things are more chaotic in the industry than they ever have been, and hopefully ever will be again. But this will pass. Things will settle again. I'm hoping within the next 2 years, once the SAVE litigation is over, and once whatever happens with budget reconciliation happens and gets implemented. But until then, there's a lot of anxiety out there. So there's some things that we just don't have answers for, mainly because some of these things have never happened before. I mean, I've researched student loan policy back to the 60s, and things like the SAVE litigation have never happened before. So I can't even really prognosticate about what the outcome might be. But the best we can do is help you understand what is happening and what some of the outcomes could be. So the Biden administration tried to create this new repayment plan called SAVE that would have saved people a lot of money, both in the short term with their monthly payment and the long term towards loan forgiveness. But 13 Republican attorneys generals filed a lawsuit against the Biden administration, saying that they exceeded their authority under the law, that the plan was basically, I'm oversimplifying, but the plan was basically too generous. That litigation is ongoing, and it sort of had a creeper effect. They weren't questioning the forgiveness component under ICR or pay as you earn, but the courts are now questioning that because the word forgiveness is not actually written into federal law under those plans, where the word forgiveness is actually written in federal law under both new IBR and old IBR. Now, Parent Plus borrowers were never eligible for SAVE to begin with, but they were if they double consolidated. Now, again, you can still double consolidate and access the other income-driven plans. So don't let the SAVE litigation sort of shy you away from the benefits of double consolidation. The litigation more recently also temporarily paused new pending and new income-driven plan applications. Those plans are now being processed again, but there's a backlog to contend with. So some people have been waiting maybe since last fall, because this is not the first pause in IDR processing that's happened as a result of the litigation. But on the plus side, because of that, borrowers, you're usually required to recertify your income on an annual basis. Except for people that were required to recertify the beginning of this year, most people got their recertifications pushed out to at least February of 2026. Now, if you have a pending income-driven application, the servicer should be putting you in forbearance if they're not able to process it right away. All right. The other thing that recently happened is the Department of Education announced that they were going to start doing what we call involuntary collections on defaulted student loans. Now, let me be very clear. If you're like 90 days past due or 120 days past due or in forbearance or in deferment, you are not in default. If you're not sure, if you log into studentaid.gov or your servicer's website, it will say a status of default. If it doesn't actually say default, you are not in default and not at risk for these involuntary collections. The other thing I want to clarify is this was going to happen no matter what. They stopped doing involuntary collections on defaulted loans for COVID. And while they started billing people again for non-defaulted loans in the fall of 2023, they still hadn't restarted involuntary collections for defaulted loans. I actually thought the Biden administration was going to start doing it back in January, and for whatever reason, they didn't. The Secretary of Education is required by federal law to collect on these loans because these loans are owed to the U.S. taxpayer. Defaulted loans, there's no private lender out there. They've always been owed to the U.S. taxpayer, so they have no choice but to collect on these loans. And again, this involuntary collection, such as administrative wage garnishment or seizing your tax refund, garnishing your Social Security, that was all done pre-COVID, and they're starting that up again for borrowers that are actually in default. Now, if you are in default, you can still prevent these involuntary collection activities by contacting the loan holder, and you can find out who that is on studentaid.gov, and it's most likely what's called DMCS or the default. It's also called the Default Resolution Group, which is basically the Department of Education. It's a vendor that works for the Department of Education to manage the defaulted student loans. And when you contact them, you can get on a repayment plan. You can also consolidate the loans out of default unless the loans are already consolidated, or you can rehabilitate the loans out of default. Both of those put the loans back in good standing and make you once again eligible for deferments, forbearances, lower payment options, etc. Rehab also removes the default line from your credit report like it was never there to begin with. Now, the delinquencies that led up to the default remain for the typical 7 years. That's your 90-day delinquency, 120-day delinquency, etc. But again, rehab removes the default line like it was never there ever. And that can really improve your credit. Consolidation doesn't remove the default line, but it does make it clear that the loan is no longer in default and is back in good standing, which can also improve your credit score. If you want more information about rehab or consolidating out of default, you can find that on both studentaid.gov or our website, freestudentloanadvice.org. The other thing we've seen recently is the administration laid off about half the Department of Education employees. Now, we're not expecting that to affect most of the day-to-day for borrowers because most of the day-to-day for student loans is handled by vendors. So your servicers, the ones that Celina mentioned earlier, Aidvantage, Mohila, Nelnet, etc. As I mentioned, the collecting of the defaulted loans is handled by a vendor. PSLF processing is handled by a vendor. What we are seeing it affect is what I call the helpers. So they laid off both entire teams that do oversight of the loan servicers. And these were also people that tended to get things fixed if there were some errors at the servicers. They laid off about 80% of the people that do oversight for colleges and universities and that do audits of colleges and universities. They laid off most of the student loan ombudsman team. They laid off a lot of the IT people. They laid off a lot of the attorneys. So I think where we are going to see an effect on student loans is if you Google Corinthian and college and student loans, you'll see there was a big problem with fraudulent schools some years ago. And I'm afraid that by getting rid of a lot of the people that do oversight of those things, that we might see it might be harder for the Department of Education to try to identify fraud and abuse at some bad actors at colleges and universities. Now, most colleges and universities are not bad actors, but anytime you have a large group and there's money involved, there will be some bad actors. I'm also afraid that borrowers are going to have a harder time getting disputes and errors resolved as a result of the RIF. Now, hopefully some of this comes back over time when they realize where these holes are, but that's sort of the immediate issues that I'm personally afraid of as a result of the RIF. We also saw an executive order where they talked about moving the loan portfolio to the Small Business Administration. There's a big question of whether that's even legal. So that is not a definite. I'm also hearing chatter that they may have sort of lost interest in that. All of that is chatter. None of that is official. What I can tell you is if the loans were to move over to SBA, I would not expect there would be no changes in the terms and conditions of the loans because those are written into federal law. And again, most of the general day-to-day activities with federal student loans are done by vendors. So, I mean, it would just really change who does the oversight of the program. And again, I'm not convinced that's going to happen at all anyway. What I am watching closely is Congress. They're in the middle of the budget reconciliation process, and that seems to be their primary goal is to get budget reconciliation done. And there could be some significant changes, especially to future student loans as a result of budget reconciliation. Now, let me be clear. We are very early days yet. So the things that I'm watching could change or go away completely by the time reconciliation is over. But what I'm looking at as potential a blueprint here is the College Cost Reduction Act of 2024 that was issued by former committee chair Virginia Foxx, and also the House committee bill that came out earlier this week. So some of the things I'm watching is the elimination of all the higher education tax credits. I think what's more likely to happen is they get rid of them, but create a new one that's just a single one that's meant to replace all of these, but that the final result would actually be a lower tax credit for consumers. That's my guess. They're looking at reducing graduate and Parent Plus loan availability for future borrowers. Now, if they did that, they'd start winding that down in 2026. And it wouldn't really affect currently enrolled students, but it would affect future students. They'd reduce the Stafford loan eligibility to current limits, but if the median cost of your program was lower than your current cost of the actual program you're in, they would reduce the annual limit even more. So there's a lot of proposals in these bills that actually both sides of the aisle agree on that would be used to encourage colleges to reduce the cost of education. So, if you were attending a program that cost more than the similar programs at other schools, the amount of loans you'd be able to borrow would be more based on the costs at the other schools than your actual program. They would limit grad borrowers' aggregate limits to $100,000. Now, right now, there's no limit to how much a graduate student can borrow over their lifetime. So this could significantly stymie those that wanted to attend a graduate program that cost a lot more than that. It also might cause these graduate programs to go down in price. Now, if you were attending medical or dental school or another or law school, that limit would increase to $150,000. The aggregate limit for undergraduate programs would be $50,000. Parent Plus, the total limit for Parent Plus borrowing would be $50,000, and that's even if you had 12 kids. You'd never be able to borrow more than $50,000 in Parent Plus. And again, this is a proposal only, and it wouldn't affect people currently in school. Now, what that would mean is that if people reach these aggregate amounts, they'd be forced to go to private loans. And remember, private loans, they have much stronger credit checks. So it's possible that, someone would have to drop out because they wouldn't be able to get a private loan because their debt to income was threatened because of the federal loans they already took out. And they might not have income because they're in school, or they might have low income. And they might not be able to find a cosigner. So there's pros and cons to these proposals. I don't mind so much that they might be adding limits. I do worry about increasing the number of borrowers that have debt in no degree because they weren't able to access private loans to finish their degree. Hopefully these proposals do end up affecting the cost of higher education in the first place, however. They are also talking about getting rid of all the payment plans that we talked about for future borrowers only and streamlining it to two plans. One would be basically a standard plan, and the other would be based on, we'd have one income-driven repayment plan. This one, the one that's in the House bill that was released this week, would have a forgiveness baked in, but only after 30 years under the plan. It would forgive any interest that wasn't covered by your payment, so you wouldn't have to worry about making a payment every month only to see your balance go up. The payment would be 1%. And again, this is based on the bill that was issued this week. There's the CCRA of 2024 have had a different, basically use 10% of your discretionary income. Um, but under this proposal, your payment would be 1% of your AGI if your income was between 10 grand and 20 grand, 2% of your income if you earn between 20 and 30, and so on and so forth. You would never pay more than 10% of your income if you had if your AGI was 100 grand or over, and the payment would always be at least $10 a month if your AGI was under the 10,000. They also would take off $50 from your payment for every dependent child you had living at home under the age of 17. Some changes that they're proposing in the future only for PSLF, and this is for people who haven't borrowed yet, but they wouldn't be able to count time that they were in a medical or dental residency towards PSLF. That's the only change to PSLF I've seen in this bill at all. People have been really worried about PSLF. I haven't been particularly worried about PSLF, and this is the only proposed change to PSLF under legislation that has any potential legs that I've seen so far. Yes, there are executive orders that could change PSLF, but I actually don't think that those have any legs legally because, of course, executive orders can't be contrary to federal law. And with that, I'm going to turn it back over to Celina. I know we've hit our time, but we've only got a couple more things if you want to bear with us.
Thank you. Thank you for all that information. Just before we take off, I do want to remind everyone of your rights under the California Student Borrower Bill of Rights, and this is applied to your student loan servicers. Okay, so we know there's a lot going on, but you should be able to contact your servicer and get an accurate information about your IDR plans, PSLF, payments, all these discharge, all these federal programs that we talked about. So this law is here to, to ensure that they do that. And if they don't, you can file a complaint with us. Contact me if you have any questions, if you're not able to obtain information, questions on payments, allocations, forbearance. We're seeing a lot of that. So just want to remind you of that AB 376. And then just also want to remind you, I think next slide, we do have a lot of the frauds and scammers. If you receive a call, text, or letter offering assistance, do nothing. Verify the company. If you are in, this does not apply to you. You may be getting calls if you are in default. That's a little bit different. But if you check your status and you're on forbearance and repayment, you're not in default, and you're getting these offers to consolidate, loan forgiveness, $0 payment, and they want you to pay, then log off, hang up on them, do what you need to do, and then go ahead and check your service or communication, studentaid.gov. There's nothing that a company can do that you can't do on your own for free. We're here to assist you as well. And then you can file a complaint with your consumer protection agencies. And I think that is the next one is just our contact information, TISLA information. We do have the Student Loan Empowerment Network as well for California borrowers. Important student aid links, but again, your managed loans, your main studentaid.gov portal is going to be where you're going to see that information to see exactly what type of loans you have. If you have Parent Plus, how many of your own loans you have, just to get all that sorted out. Betsy, thank you so much. Always great information, great webinars, and we will see you next time. Everyone have a great rest of your day.
Thank you, Celina, and thank you. I love partnering with you. I also really want to make sure we thank the Rose Foundation that made these series of webinars possible. They made a very generous grant specifically to allow us to offer these free webinars. We won't be sharing the slides, but as Celina mentioned, this recording will be on their YouTube channel within the next week or so. So thanks everybody for coming.